I want to share some information about reverse mortgages and when they can be an excellent fit for your financial plan to enhance retirement. In Montana, when we are talking about reverse, we are generally talking about the home equity conversion mortgage, or HECM. You will hear both terms, reverse and HECM, so keep in mind they're the same for our purposes. There's a good chance that you've spent years building up the equity in your home, so why not put it to use to create a better financial plan? Dr. Wade Voss's financial planning research has shown that coordinated use of a reverse mortgage starting earlier in retirement outperforms waiting to open a reverse mortgage as a last resort option once all else has failed. Reverse mortgages have transitioned from a last resort to a retirement income tool that can be incorporated as part of an overall efficient retirement income plan. We'll get into the history and details of a reverse, but I want to start by going through the multiple challenges a reverse can help solve. If you currently have a mortgage, you could increase your cash flow by eliminating the mortgage payment. Keep in mind that you are still responsible for taxes and insurance. It can help preserve investment principal as you postpone drawing down retirement assets. It can be used to protect against sequence of returns risks by using a coordinated withdrawal strategy. You could fund a long-term care policy or use the line in long-term care planning. Increase Social Security benefits by delaying your start date. Potentially reduce your tax liability as loan funds are tax-free. Of course, you'll want to consult your accountant for the best tax advice. The line of credit grows and has easy access to be able to make home improvements, assist loved ones, etc. This is by no means a complete list. It is such a flexible product, it can be used in so many different ways. Works. So we'll start with the history. And HECMs are regulated and insured by the Department of Housing and Urban Development. The first one came out in 1989, and the government has been proactively adding industry safeguards ever since. In 2008, extra licensing for loan originators was required. A counseling requirement was added in 2012. In 2014, protections were added for a non-borrowing spouse, and the next year brought additional financial assessments. So at the most basic level, a HECM is a way to convert home equity to a usable resource. You maintain title and ownership. There is no monthly mortgage payment required, but if you wish to pay, you can do that to lower your loan balance. You still pay property taxes, insurance, and any other fees that would be required for your home. Requirement-wise, it will need there's generally lower income requirements and credit requirements than with a forward mortgage. You are required to maintain the property, and the borrower's age, home value, and expected interest rate are what's going to determine the principal limit factor, which is the amount that can be borrowed. So key points I want to stress: the amount of borrower control you have and how flexible the product is. If we look at ways you're protected, it is a non-recourse loan, meaning you can never owe more than the home's value at the time of payback. You can never be asked to leave your home as long as it's your primary residence and you're staying current on taxes, insurance, and maintenance. Reverse mortgage counseling is there for your protection so that you speak with a third party to look at everything and make sure that it feels like a good fit for you. The mortgage insurance guarantees the non-recourse protection, as well as helping to make sure that the line of credit will work as agreed upon by the loan terms. It won't affect Social Security or Medicare. And on the adjustable products, there are interest rate caps in place. You would qualify if you are 62 years or older and a homeowner. Multiple properties are eligible: single-family condos, 2 to 4 unit, etc. And as far as underwriting, there are requirements under there. It's looked at a little differently than a forward loan. Mostly it's making sure that you obviously can meet the obligations of the house, and then it goes off of a residual income calculation. Satisfactory credit history, it's less looking at score like a forward does so much, and more just looking at it to make sure that, again, you are not delinquent or etc. Different ways you can tap into your equity. You can take 10-year payments, which are for your entire life as long as you are living in the home, regardless of the loan balance or the home value. Term payments would be equal payments for a fixed period of time. Lump sum could be available depending on the loan program. And then the line of credit option, which gives you available access to funds as you wish when you want to take the draws. And that line of credit will grow over time. What about costs? Most of the costs for a reverse mortgage are similar to what you'd have in a forward mortgage. Appraisal, title services, credit fee, origination fee, taxes if they happen to be due within the period, and the recording fees to get it registered with the county. The unique fees to a reverse mortgage are the counseling, which gets paid for generally in advance, and then the reverse mortgage insurance, which is insurance, so you are paying for it no different than any other insurance policy, which is where the protections come in, again, so that you would never owe more than the value of the home and to protect the line of credit growth. Steps to get a reverse mortgage. It starts with a consultation. We'll go through where you are, what you're looking to do, etc. The value of your house. We'll run some illustrations. That's the time that I can answer any questions you have, etc. Once you have your illustration, you'll be able to take that into counseling and meet with a third-party counselor. They're going to go through more numbers, make sure that you understand everything. And then if you want to proceed, we move forward with the application. We'll gather the documents needed, and then at that point, that goes into underwriting and the appraisal is ordered. The appraisal goes out to make sure, determine the home value, etc., and condition of home. The underwriter will review all of the guidelines. Once everything's approved, we move to closing. Closing will generally be done at a local title company. All of the final loan documents will be closed, and then recording will happen with the county. Depending on if it's a primary residence that's getting refinanced, there's generally a rescission period, and after that, it gets recorded and funded. There are a lot of myths that are going around about reverse mortgages. You may have heard a few of these, so I want to go ahead and address them here. One is that the bank will own your home. No different than a forward mortgage. You are the one on title. The bank is a lien holder. Myth that the bank can kick you out of your home, again, like we talked about, as long as you're staying current on taxes, insurance, etc., and you are living in it as your primary residence, there you are in good standing. The idea that you could leave your children with debt, no different than you can't be responsible for more than the house value. Your heirs cannot either. And in fact, if it were true that the loan balance was higher than the market value, your heirs could actually retain the property by being able to basically purchase it for 95% of the current market value. Of course, if the loan amount is less than the market value, then that's the amount that they get it for. And then the idea that the HECM is only used as a last resort. I've showed here that it can be used as a very key part in an overall strategy as you're getting into retirement. So what events would make the loan due and payable? If the home is sold, vacated, or abandoned, when the last borrower either passes away or moves from the home for 12 consecutive months, if the homeowner fails to uphold any of the mandatory responsibilities, including staying current on taxes and insurance and maintaining the home. You or your heirs are the ones responsible for selling your home. And the time frame for that, if it's a sale, you have 6 months, which can then be extended up to a year. You can apply for 2 different 6-month extensions. Your heirs can do the same. If you are put into a nursing home for longer than 12 months, then that would require it to be due. And if you move out but keep the home, you would want to refinance before that, because in that situation, it would become due because it's no longer being used as your primary residence. So the important payoff features, if the loan balance exceeds the house value at the time of payback, you're still protected and nothing more is owed. And if the house sells for more than the outstanding loan balance, no different than with a forward mortgage, you or your heirs are going to get that difference. Some key points I want to go over regarding the line of credit option. The credit line grows regardless of the equity position in the home. It's open-ended credit. You borrow from it, pay it down, and borrow from it again, although payments are not required. It's secure. It cannot be reduced, frozen, or eliminated because of real estate market declines or the home's future equity position. It's liquid. Cash is typically available in 48 to 72 hours. It's not taxed when drawn upon, so strategic draws may allow a homeowner to remain in a lower tax bracket. Compound growth. The interest is the same as the note rate plus the mortgage insurance. So if the interest rate increases, the line of credit growth rate increases as well. Again, just to reiterate some of the main takeaways, you have your choice of payment, a choice of how funds are used, a choice of when funds are used, and a choice of when payoff occurs. So I hope that this was helpful for you. If you have questions, please reach out, and I'd love to chat with you.